Let me start off by talking about amortization and the amortization process. It's a systematic method of paying down a loan, basically, where you're making principal and interest payments. Now, it's important to understand that on the very front side of any new loan, your interest amount is really high, the principal amount is really low. But over time, as you pay down the debt, as you pay down the balance, they reverse roles. The interest portion gets smaller and the principal portion gets larger. The payment remains the same. It's just the relationship between the principal and interest will shift. As far as a partially amortized mortgage, what you're doing there is you're making payments, but there's not enough payment made to pay out the entire loan. At the very end, you're going to have a balloon payment. The adjustable rate mortgage is a mortgage that where the interest rates may adjust up and down each year. It's based on an index and a margin. The index is always going to fluctuate. The margin is the profit, and it will always remain the same. As far as a package mortgage is concerned, that's both real and personal property. A blanket mortgage is what a lot of developers do. A blanket mortgage is where you have a large parcel and there are a lot of lots inside that parcel. What developers will try to do is sell off individual lots. In order to do that, they're going to have a release clause. As far as a home equity loan, all you're doing with a home equity loan is borrowing money against the equity in your house. The reverse annuity mortgage is a mortgage that's being used a lot today. And what the reverse annuity is you're borrowing on equity already built. And what typically happens is you can either borrow it all at one lump sum or you can take payments over time. That becomes a lien on the property that has to be paid at a later date. Regarding the term mortgage, all mortgages in the very beginning, many years ago, were term mortgage, which means interest only. Today, obviously, that's changed. Let's talk about government-insured loans. The government-insured loan that we have today is the FHA insurance program. The FHA is not, well, let's put it this way. The FHA does not lend money. The FHA simply insures money. And it is run through the Department of Housing and Urban Development. The insurance premium for the FHA is paid twice, one up front and then monthly. The upfront mortgage insurance premium is one amount, and then you'll also add in your monthly insurance premium on a monthly basis. Regarding the qualification ratios for the FHA, FHA has certain qualifying ratios that lenders have to look at. They call it the front side ratio, the back side. Your housing expense ratio for FHA is 31%. In other words, your housing expense, your principal, interest, tax, insurance, should not exceed 31% of your gross monthly income. Your total obligations for anything, or your total obligation payments for other bills, should not exceed 43%. Now, I want you to be careful on the test, because what they may give is a weekly salary. Remember, we're going to take our weekly gross income, multiply that times 52, because there's 52 weeks in the year. Then we'll divide that by 12, and that'll give us our monthly gross income. Regarding the VA, or the Veterans Affairs, is a guarantee. Again, the VA typically doesn't make loans, but the VA will make loans in those areas where there are no VA lenders. What the VA does, though, is they will guarantee lenders against default. It's very much like the FHA insurance. Let me say this. With an FHA insured loan, there are loan limits in terms of the FHA. With VA, there are no loan limits. There are guarantee limits, however. The top guarantee limit right now is $104,250. That's the most guarantee. Or 25%, whichever is the lesser of the two. And if you were to take $104,250 and divide it by 0.25 or 25%, the maximum loan that the VA will guarantee without a down payment is $417,000. Now, a person can borrow money to buy on their VA guarantee. For instance, if the home was $517,000, you can use your VA to buy. The first $417,000, nothing down, but that $100,000 above that will require at least 25% equity for anybody to get into it. Also, remember that the VA loan is based on the guarantee amount. As far as conventional loans are concerned, conventional loans rely on private mortgage insurance to cover that upper 20% of the loan to value. As far as the ratios are concerned, conventional loans are a lot more conservative. The housing expense ratio is 28%, and the total obligation ratio is 36%. The primary sources for home financing, a couple of issues that I want to talk to you about real quick. The difference between intermediation and disintermediation. Banks are considered to be intermediaries. Banks, savings and loans, credit unions. What I'm talking about is that when you put your money in a savings account or in a checking account, they're going to take that money and lend it out. They are middlemen. They are intermediaries. If you want to practice disintermediation, what you're going to do is eliminate that banking system where your funds are. A good example might be seller financing, where instead of taking your cash at closing and putting in banks, what you're going to do is do seller financing, and that will eliminate that middleman. Regarding the various sources of financing, savings and loans have been around for a long time. They're a great source. Commercial banks are a great source of financing. Credit unions, mortgage bankers, and mortgage brokers. I want to make sure we know the difference between mortgage bankers and mortgage brokers, though. Mortgage bankers are banks. They have the ability to make loans. They have the ability to approve loans. They're banks. A mortgage broker is not a bank. A mortgage broker is an individual or a company that simply brings money together for that person that needs to borrow it for a fee. The mortgage broker cannot approve loans and they cannot make loans. Also, let me make a comment about life insurance companies. Life insurance companies are the largest lender of large-scale commercial loans. One of the reasons that life insurance companies are so successful is that, one, they're only regulated in the states that they do business. That means that they're not federally chartered and federally regulated, which gives them a little flexibility. And secondly, they got a lot of money, a lot of liquidity. And there's also some private funding out there, Guido, I would think. Typically speaking, if you're borrowing from that private sector, interest rates are going to be a little bit higher. The Federal Reserve Bank, I think the most important thing to remember about the Federal Reserve Bank, the Federal Reserve Bank is the central bank of the United States. It is not the United States government. It's a private corporation. Its job is to implement monetary policy that stabilizes our market, that doesn't allow inflation or recession. Three ways that the Federal Reserve Bank has to influence money: changing the discount rate. The discount rate is the amount of interest rate that local banks are charged to borrow from the Federal Reserve Bank. As the discount rate goes up, interest rates typically go up. Changing of the reserve requirement. In other words, how much money do banks have to keep on hand at any given time and not be able to lend out? Anytime that reserve requirement goes up, there's less money in the system to lend out, which means that interest rates typically go up. The most successful, or the method that is relied on more for long-term real estate money as the I guess the benchmark, is the open market operation. Now, what the open market operation is, real simple, is the Federal Reserve has a certain amount of money in their system. As that money is depleted, taken out, there's less money in it to lend out, which means interest rates go up. The biggest borrower from the Federal Reserve Bank is the United States government. And as the United States government pulls money out, borrows money, leaves a bond or a note, if you will, that depletes the funds in there, which cause interest rates to go up. So the open market operation is the one method or the one operation that we look at and say, How does this influence interest rates for real estate for long term? Regarding the secondary mortgage market, there are a lot of various places that mortgages are bought and sold. Probably the three big, the ones that have been around the longest. The Federal National Mortgage Association, better known as Fannie Mae. Fannie Mae was created in 1938. Its primary job was to purchase the FHA insured loan. Today, Fannie Mae will buy all three types of loans, FHA, VA, and conventional. Ginnie Mae was created in 1968 to work in tandem with Fannie Mae to be a subsidy. In other words, in order to make low-yield loans, Ginnie Mae was created to make up the difference in loss of interest rate. The last is the Federal Home Loan Mortgage Corporation, better known as Freddie Mac. Freddie Mac was created in 1970. Freddie Mac's original job was to purchase conventional mortgages from S&Ls. Once again, today, Freddie Mac buys all three mortgages, FHA, VA, and conventional. So Fannie Mae and Freddie Mac today have basically the same functions, but when they were created, they certainly had different functions. Fannie Mae bought FHA loans. Freddie Mac bought conventional loans. Laws regarding fair credit and lending procedures. First of all, the Equal Credit Opportunity Act. This is the one federal statute that prohibits discrimination because of age. The others do not. The Consumer Credit Protection Act is also known as the Truth in Lending. What this is a disclosure law. It requires lenders to disclose to borrowers the true cost of borrowing, which includes other closing costs as it relates to the loan. And this is expressed in the annual percentage rate, the APR. And what has to happen is that lenders have to disclose the APR within 3 business days of application. If the APR changes as little as 1/8 of 1%, then it has to be redisclosed. And it cannot intrude within that 3 business days before closing. You have to have an extension to move it out. The Real Estate Settlement Procedures Act are rules that require lenders first to deliver to borrowers an information booklet on borrowing. In addition, they have to deliver to borrowers a good faith estimate of closing costs. Now, this has to be done within 3 business days of application. In addition, TILA RESPA is a combination of the Truth in Lending Act and RESPA, has new rules regarding the disclosure of closing costs. Lenders now have to disclose to a borrower their integrated closing disclosure form at least 3 business days prior to closing. Now, this is only applicable to those closings where it's a residential transaction and a lender is federally regulated. And that is all we have for our mortgage market. So, to begin with, amortization is a payment of principal and interest, more interest than principal on the front side, but that all changes over time. The adjustable rate mortgage consists of an index, which changes each year, and margin, which is fixed. A blanket mortgage covers more than one parcel of real estate and typically needs a release clause to sell individual lots. FHA is insurance with underwriting guidelines of 31% mortgage payment and 43% of total bills. The VA is a guarantee based on the loan amount. Conventional mortgages require private mortgage insurance on the portion of the loan greater than 80% loan to value. Banks are considered intermediaries because of savings and checking accounts. The open market operation is the most effective method the Federal Reserve has to influence interest rates. Fannie Mae was created to purchase FHA mortgages. They don't lend money. The Truth in Lending is regulated through Regulation Z of the Federal Reserve Bank. The Real Estate Settlement Procedures Act requires lenders to provide an information booklet within 3 days of application, a good faith estimate of closing costs within 3 days of application, and this applies to all federally related residential loans. Intermediation is putting money in a checking and savings account. Disintermediation is diverting funds to other investments. The housing expense ratio is your monthly gross income times that housing expense ratio. The total obligation ratio is your monthly gross income times your total obligation ratio minus other debt.
And that concludes this chapter's review.